A lot of times people hear about low advertised rates online or on the radio, but those rates almost always come with fine print, like points or origination fees, and they also make assumptions about the specifics of your situation. In reality, there's over 30 different pricing factors that can impact your rate. Look, if we weren't competitive, we wouldn't close as many loans as we do, but almost everyone who talks to us ends up financing with us unless they feel obligated maybe to use a friend or a family member in the industry. Rates are usually the first concern and the most common question I get, so here's how it works. Rates are determined by the secondary market's demand and the perceived risk of the loan. And loans are initially funded by lenders like us and then sold to larger investors or transferred to a servicing department, which can feel like the loan's being sold. And then there's banks like B of A and Wells Fargo that raise funds through deposits, and then they lend that money back at competitive rates, but there's strict guidelines disqualify many people. There are mortgage banks, on the other hand, that secure large sums of money from investors and use them to fund loans, but they still need to sell those loans on the secondary market to continue lending. And these loans are often bought by institutions like Fannie Mae, Freddie Mac, or even other banks like Chase or Wells Fargo. And if the secondary market won't buy a loan, the lender has to hold on to it until it's, less risky, which basically impacts future lending. There are government-insured loans which have stricter requirements because they're designed, to ensure timely payments, making them attractive to buyers. But when your loan is sold, it's often bundled with others into what's called mortgage-backed securities, and investors buy these. This process is actually called securitization, which frees up capital for future loans. The rate on these securities does fluctuate based on supply and demand. If there's high demand, there's lower interest rates, and low demand drives rates up. So there's investors like pensions and hedge funds which prefer loans that have long-term commitments. So if a loan is likely to be refinanced quickly, it's actually less valuable to them, and that can drive up costs. Almost all lenders get their funding from the same sources, so rate differences between lenders are typically small, like paying a little more for a gas at a different station. But what really matters is who you choose to work with. Our reputation for strong, underwritten pre-approvals helps you get offers accepted. It protects your earnest money and ensures timely closings. And we're committed to providing exceptional service, answering all your questions, and making sure you have everything you need to make an informed decision before, during, and after the biggest purchase of your life. If you have any questions, feel free to reach out. Have a great day, and thanks so much.